Then you remember few words about yesterday. Then yesterday we spoke about the key features of renewable energy projects. Then there was this business of intermittence, and then unpredictability in the generation, which were really two main themes which drive us to explaining how we will approach the various projects, knowing that they are selling into a market. On this market has also certain constraints, and you remember we were having categories like A, B, C, D, E. And now what we will be doing, we will somehow take stock of what we learned yesterday and see how it impacts both blending and PPPs. Because you remember, and I think it was one of the wish expressed by the group to say, look, we would like to discuss renewable energy financing, but there is two things that clearly drive the financing process. First, the role of the public sector. Second, what is blending. And now, not to spoil what we'll be learning, but instead of taking the approach of blending from, let's say, the top, because usually a lot of conferences we spoke about, or we heard about Sevilla from many people already yesterday. But it's true that there is a lot of information available from people who speak about billions, trillions of investments. Now, this will be an approach, but we will complement it from a kind of bottom-up by thinking, look, where in my project could I blend? Not for the sake of blending, but really because it serves my purpose as a lender to bring other partners. And this is what we'll be learning together. And you will be somehow surprised to discover that for a renewable energy project, there is clearly a benefit arising directly from blending, because otherwise it's just a constraint for you, whilst it shouldn't be. Then now, we have to remind ourselves that all our presentations here today are a lender perspective. Now, if you were a developer, we might have taken a different approach, but here we are among ourselves just lenders, then we will only look at it from that perspective. And as I was just explaining, how is blending helping us mitigate our risk and optimize our financing? The financing plan that you are used to is consisting of uses and all project cost. Then we have the construction, contingencies, legal, interest during construction, taxes, and what we call a debt service reserve account. Are you familiar with the concept of debt service reserve account, all of you, or would you like me to just explain again what it is about? So basically, what is happening, because you have in any project a risk of outages or delays or whatever during the operation, in order to mitigate the risk of you lender not being repaid during 6 months or during a year, you will tell your project developer, please put aside an amount of money so that in case something happened during the year, I could get repaid. Then I don't have like nothing during a year, which is, or 6 months, which is not very good. Now, for renewable energy project, as you could appreciate, this is critical, in particular for technologies like run of the river. We spoke about it yesterday. There might be years of drought where there is like very little, if any, production. Then instead of saying, look, you lender can't repay me, you will use that account to pay you. There is a feature, however, that we will discuss later. In many, or it started, let's say, with renewable initiatives, in particular for PV, where a lot of developers, instead of funding the debt service reserve account, said, look, you know what, I don't want my money sitting on an account. I will organize for you a facility, and we call it debt service reserve facility. And we will discuss it later. It's very typical for a PV solar plant. And now, in front of the users, you have the sources, where you will list all the finances. the amount they are financing, the currency, and any restriction either in terms of use of proceeds or in terms of timing. In terms of use of proceeds, it's quite important because when you blend, some agencies will only do certain type of actions. Let's take GCF. GCF will be very good at financing your consultant. You will have other entities, IFIs for senior lending could do it, but if you go for national bank, they might not be interested because they have to show that they are financing real stuff in their own country. You see, when you have your annual report on your national bank, you better say, look, I did finance that company locally, rather than saying I finance an international consultant coming from USA, which is nice, but totally irrelevant. Then some finances will impose on you certain requirements. I do finance that project component or not another. One thing that came on here, you might have on I guess all of you, it would be interesting to hear what is your experience. But it's a fact that over the 10 last years, in particular for renewable energy project, the financing was, I would say, very tight. By tight, I mean the gearing, which means that a relative portion of debt versus equity was very high. Very low equity, very large amount of debt. When I started working, minimum equity in power sector would have been 30%, maybe even 35%. And this was for project with no risk, like a coal-fired plant in the old good-fashioned countries where everybody is buying electricity. 35% equity, and as you could imagine, the cost was very high. And then the pressure on cost, plus, and we will see other reasons, like lenders being more familiar with the technology, led to a situation where the financing plan was very tight, meaning very low equity, very high amount of debt. Good thing for us was that obviously it lowers the financing cost because the return on equity is much higher than the interest you pay on the debt. Then de facto project cost benefit, and it increased competitiveness. Remember from yesterday, one of our risk competitive. Here you reduce the cost of your plant, de facto you reduce the cost of energy produced. Now, big problem for us in the renewable field is that it reduces substantially the sponsor exposure to your project. If you put little money and you lose it, and you don't care. And now there is a second issue that we will see in the financial model this afternoon, is that many sponsors extract cash very early. And now if you compare amount invested and amount extracted, after year 5, if you don't carefully monitor how they extract funds, they already made their return. Then there is, how to put it, a real incentive on you to make sure that whatever amount a sponsor put on a project, the return is delayed so that they don't cash out too early in the way they structure the project. Then now, this situation was possibly exacerbated by the fact that there was a huge competition among lenders. I guess yesterday I spoke to you about Benban in Egypt, which was possibly, I think, the excessive example, where all the IFIs rush to get into these things, and we were ready to consent any kind of conditions, I say any, almost any kind, accepting a level of equity which is, in my view, just personal view, far too low by comparison to the country. Egypt is still a high risk, and the fact that we're having a huge capacity to dispatch, and nobody knew what will happen. And I guess what will come next is that after 15 years, what will be the effective performances of all these power plants? No one knows. Then, in fact, clearly lenders were putting almost pressure back onto the sponsors. But things have changed recently. First, market conditions. You remember Demba mentioned it, and it was also in one of my slides. And the 20-year AAA bond is back to what it used to be like 10 or 15 years ago, then money is more expensive. Then clearly it changed a bit the dynamic here. And the level of competition, I think, in the recent past has been much more sensitive to the quality of the assets. I think between lenders, surely. I don't know, you have your experience, but my impression is that if you take almost the kind of pre-COVID time where everybody was rushing green, I mean, people were not, back again to Egypt, were not that sensitive to taking such a large exposure in a single country. These days, a bank will say, look, maybe a bit here, a bit here, a bit here, because not a single country to that thing. If I take my former employer experience, you will not believe that over 10 years at EBRD, Aqua became the largest single exposure. Aqua. It used to be a bank, now it's a developer. How could even an IFI accept that a single developer is the largest exposure of a bank? I mean, it's insane if you think at it. It's then, and I know that, I don't know if you know Nandita Parshad, but she used to be the MD in charge. Now she's, surprise, at the board of Aqua. Well, no comment here, but it's a fact that even she realizes that it's too much. And there is a time now where people must diversify their portfolio. Now, what will you be doing? Then we will discuss financing structure and structuring. Then we are getting into this blending stuff here. And again, at the risk of repeating myself, because I was in your shoes not that long time ago, blending, to be honest with you, I don't know about you, but for me, was a pain. Because it was coming from my boss. You will work with that. I mean, I'm not interested because I was incentivized on the amount of loan I was providing each year. Then by asking me to do that, they were reducing my bonus. Thank you. Second, you end up in a nightmare in terms of legal agreements, and then you have to sell it to your client. Because the clients, they only want one partner. They don't want to hear about 10 people coming on each meeting, on each of them being different, and then you have a nice French accent, but then you have a Canadian guy coming, and then a Mexican guy coming on. I mean, you are lost. Then, at the end of the day, for you, blending is a pain. But you might realize that this pain could be beneficial to your project. And this is somehow what we will try to demonstrate here. Then it's not only about the big guys coming with trillions. No, it's also something that could enhance the project financing. Now, we will start with the various facilities, and I would assume that you start being a senior lender, then you will provide the bulk of the financing. What will you be doing? You will first set your PXX scenario, and then you will target a minimum DSCR. And why would you be doing that? It's just because since in essence your production is not set in stone, and then you have to make some assumptions. In fact, you will reverse almost the process by imposing a production level, P90, and then you will design your senior loan so that you are able to meet that P90. And the model that you will be given this afternoon is exactly doing that. Then it's profiling the debt so that every year on a P90, you are at DSCR of whatever. And we'll see which one is the most suitable. Then this will set for you the maximum loan amount and repayment profile based on, and again, this will be your assumptions. You will work usually door to door because it's a bank exposure. For renewable infrastructure, I don't know, I mean, because you know all the portfolio of your bank, what will be the kind of average tenor of your loans for this type of things where you work? Yeah, this type of maturity. But again, Ben, we went up to 25 years at EBRD. Again, in my view, it's far too long because, as you know, the efficiency of these PV panels decrease quite a lot per year, like 1%. Where are you at after 25 years? then in fact no one even knows, because there isn't like a PV panel with the technology we know today that has proven 25 years of operation. Then I think it's a huge bet that people made. Anyways, you will end up, and this is a sexy word, with a sculpted debt. Then sculpting the debt is what you will be doing on renewable energy project. And again, this is totally different from another type of project finance. Why is that? Again, because if you take another, I would say, transport project or whatever, you will look at what we call traffic ridership. Then you will make assumptions. How many tickets will I be selling? I assume I sell them, and boom, you got your revenues. Or you have a project that sell on an open market. You just have a production, you sell it, you set the price. Here, we do that the opposite way. Then we make sure that all that amount is affordable using these scenarios. Now, I have here now this reference to junior debt. On junior debt, this is where blending will start. Because what will happen, and you will see it's just mechanical, it's not like like smart science, it's just a fact which is the consequences of the technology we are using. What is happening is that we will need to optimize the way cash is used by setting a kind of repayment priority and an approach to security. I guess you are all familiar with what we call subordination. Then who would like to just share with us what is subordination and the type of subordination, if somebody knows about it? Not Usama, because he doesn't. No. But yeah, if any of you know about subordination, there is two types of subordination. And what are they? Lawyers will never tell you these things, because they will say, yes, you are subordinated. Okay, I am. But what does it mean in effect? Exactly. But in fact, this is, or maybe you would like, yes, to repeat to colleagues, you have subordination in terms of access to security. However, this directly depends on the law where the assets are based. Some, I remember financing with Alstom project in Italy, for example. I think we have some people from Italy here. Yep. If not mistaken, I remember that under Italian law, you have a right for lenders to be or not securitized in a different way. Then, in fact, which is not the case in France. Then if you are lending in France, there is only one rank. There isn't like a subtle difference if you are having access to assets. And in Italy, I remember when we were trying to finance, it was line 5 in Milan, then there was this business of getting or not access to the security package as a lender. And the treatment was different. Then you have a subordination, whether you have or not access to the assets, in case, obviously, of bankruptcy or something not doing well. Then you are in a scenario where you are clearly in trouble. Then this is one. The second is subordination in terms of access to cash. Then it's your ability, you are junior, to say, look, I would like or not to be repaid this year. And I accept that it will postpone my repayments, and I will keep my exposure high because I won't have access to cash. And then again, you are in category 2, which is deferred repayment, subordination. So you are subordinated in terms of access to cash, which is different from security, but you could have both, but anyways. And then if you are deferred in repayment, you might say, look, I accept to have my interest paid, but I accept also to delay principal repayment. And you will see that in our case, this will come very, very handy. And this will be where blending will come up. Because then you will realize that first loss will come as a natural tool. And we will explain how it works and how you could optimize your financing. Then what we will be doing, we will then have first this repayment stuff. And then I wish I could have presented another approach to how we slice the cake and how we extract some of the facilities. And these are two facilities that come very handy for you depending on your approach. First, it's the famous debt service reserve facility, and second will be the VAT facility. And I will describe later what they are and how you could structure them so that you blend, because each of these facility could have a different lender, and you will see it's a nice way of allocating funding. So now, because we have this business of uncertainty, we will then, depending on the technology, define our project and generate cash in excess of our P90, and we will explain how we use that cash. Then here, what are we trying to demonstrate? Is the following, where first, as it is like kind of common sense, all renewable energy projects don't use fuel. Then operating costs are negligible. Then as a consequence, whatever additional revenues we have translate into increase in gross margin. That one is simple because I don't burn coal, I don't buy gas. Then if I increase my revenues, basically, it's just my margin which increase, then it's cash. But now, second thing we have, you remember when we spoke about volatility, there is between average production and the PE, whatever we'll be using, a difference. Then normally your project will produce in average. I mean, there is no reason why you won't have an average production over 20 years, normal. But what happened is that you sculpted everything on the basis of a P90. Then what is happening is that in average, each year you will be generating this excess cash, which convert directly in your gross margin. Then you should appreciate here that the way we structure a project generate additional cash. Unlike many other infrastructure projects where we don't have that approach. First, because the OPEX are high, then yes, I increased my revenue, but everything went into, for example, take a gas turbine, you pay the gas, but you use your gas turbine much more. And usually it's counting on hours. On a PV solar plant, no, it's more the year or the age of the panel. It's not the amount of energy produced. Therefore, in our case, we will clearly have direct consequences of P90 being converted into increased gross margin on cash. Then, obvious, but good to remember that renewable energy projects generate excess cash, de facto, in the way they are structured. And here you could see me getting into, hey, what we will be doing with that cash, hence the blending and the facility we'll be having. What happened is that we have also to keep in mind before we move to the next slide that there've been this increased interest from financiers in sustainable development. I think over time, lenders became also much more familiar with the technology, particular for wind, for solar. And as a consequence, they were possibly more eager to get into a deal and maybe to take some junior position. The gearing became very aggressive, and then there is this higher amount of cash available for debt repayment. Now, the second thing that this situation led to is, you remember that business of high gearing. I told you, and I guess you all experienced situation where gearing went from 70% debt, 30% equity, to 85% debt, 15% of equity. Now, if you realize that and you think at it, and it's quite interesting to see the consequence it has. Why is that? Because any lender will use a DSCR, normal. However, a DSCR applied to a high level of debt hasn't exactly the same consequence to a DSCR applied to a low level of debt. And this is, in effect, what is happening. If you look at it, this is my renewable project. My gearing is 1585. If I apply exactly my same DSCR, look at my excess cash available, 27. I take a lower gearing like I used to, 70-30. I only have 14. Then again here, what I'm trying to demonstrate is that we have two features from renewable energy that generate excess cash. The P90, which is different from the average, and second, the gearing. Then now you are building a pile of cash, and the question will be, how do I use it? Because back to my point, you don't want the sponsor to take it, because otherwise you are left naked. There is no one. But here, this is where, and this is the rationale for this morning, blending become for you a need, not any longer something imposed on you. Because you have to blend because you would like that cash to go out to somebody that deserve it, not the sponsor, basically, because you are a lender. Then this is what we'll be trying to do. And as I said, you don't want shareholders to get everything. In particular, because remember, low gearing or high gearing, sorry, then very little amount of equity means that whatever excess cash they have boosts their return in a way which is insane and possibly unfair. Then you will have, and this is what we'll see with the model this afternoon, to put in place what we call a dividend lockup. Then I don't know if you're familiar with this concept. Then basically, you will tell in your lending agreement, look, pretend to be American, look guys, you don't take money unless the conditions are met. And otherwise, then option one, you leave the cash in the company, bit stupid. Or option two, junior lenders, it's your time to get your money back. And this is what we will show in the thing. And all of you are familiar with what we call a cash waterfall. Basically, we will have in our loan agreement a structure whereby we will take an amount of money, $1, and it will go run through all the steps where number one get priority over number two, over number three, and then you define who is getting what under which condition. And again, in this afternoon or this morning presentation, I will show you a typical cash waterfall, how you could use the cash and how it trickled down to the thing. And then, oh, sorry, I should have shown you that one. Then you will have allocation through junior debt or mezzanine, which is a kind of, I mean, it's the same concept. It's junior slash kind of quasi-equity. And then you have mandatory senior debt repayment. You might remember not that we would like to kill or Demba today, because answer to the question wasn't good on Demba's presentation and already. Yeah. But anyway, you remember that he told us about the benefit of hedging all the risk in terms of currency and in terms of interest. There is an issue arising on, I have to warn you, coffee is coming, then, but nobody has the right to go to get a cup of coffee. Pressure on you. Then what is happening is that when you put in place a hedging instrument, could it be for currency or could it be for interest, you are in a contract with a third party. That third party expects a stream of revenues, which means that you will be committed to a certain cash flow in a currency or in terms of interest. If you break the deal, bad for you, because then you will have what we call unwinding cost, which is the cost of unwinding or unlocking the agreement. It depends how currency fluctuates or how interest fluctuates, but there will be anyway a legal fee, for sure, and then you might be at a loss. Hence, this idea, if you have a mandatory, if you have a mandatory senior repayment, obviously it's mandatory in a context where you are not expecting that cash. Then you might not be hedging the total amount of debt, because otherwise you can't take your mandatory repayment. I don't know if I'm clear, but you were hedging based on a certain repayment schedule. But you decide that there is cash and you want money back a bit earlier. It wasn't the term of your hedging instrument, then the guy will say no. Then be careful, and you remember my slide from yesterday, hedging 70%. This is a trick, no more, so that you keep maximum flexibility. And then The 30% will come handy when you have the mandatory prepayment. Again, the model will tell you if you don't want to force an earlier repayment, hedge 100. But if you have that clause, run a scenario at 50% production, try to find out how much cash you might get back in advance or prior to what was scheduled, and then set your hedging instrument accordingly. So to avoid a situation where you prevent yourselves from almost implementing what you got in mind. Now, two facilities are very useful for you. Now I have to make the survey we made already yesterday. Who is coming from a national bank having local currency? Our friends from Croatia, then one. You can no. It's just a possibility, meaning by having access to local currency. Sorry, direct access. If I take again, you're right. I should be more precise. At EBRD, we are lending in local currency, but all our funds were in euros, and we were sourcing local currency on lending local currency. Now here, I'm asking those of you who have deposit in local currency on lend in local currency, so that they don't have unmatched things. Then you only one. Whoa! Because otherwise, in Croatia, yes, you are in euro. Then now only one. Bon. Then good to know. On what will happen with VAT facility? Which is very appealing for lenders in local currency. First, VAT is paid upfront, and although it's a percentage of the value of the equipment delivered, it's always paid in local currency because it goes to the taxman, then local currency. Second, it's very appealing for a national bank because it's paid upfront before COD, and it's recovered normally through a receipt from the tax authority. Then here you could see the benefit. You are not any longer exposed to the project risk, you are exposed to the taxman risk. Then for a local bank, because one dimension that we should also obviously take into account, a lot of national banks are heavily regulated and they are not allowed to take project risk. Because it's national bank regulations, they would say, look, we don't allow you, in particular in developing countries, to take any loan except if it's fully collateralized or fully securitized or a risk in my own country. Because otherwise, in terms of regulation, it doesn't work. Therefore, VAT facility for us, or for national bank, will be a dream because local currency, repaid in local currency with local exposure, because you are exposed to the tax authorities. Now take the same the other way around. You are a senior lender coming from abroad, and you would like to expose or to reduce your exposure to the government or to any change in politics. That one is great, because by putting a local bank directly in your project with a tax, you know that if something goes wrong, you will have somebody more powerful than you to go to see the government to say, hey, I've got a problem here, I can't get repaid. And these are the local people that at the end will lose the money. Then, very good to extract a facility to increase almost on purpose your local exposure so that you mitigate your political risk. Then there is, again, and you could see me going to blending as a benefit, because then getting partners is not any longer coming as a constraint. No, it's a benefit for you because you cover your political risk and you will lower your financing costs. Why is that? Because a local bank will be better than you to source local funding and to accept a repayment in local currency. Then this is VAT facility. Then lot of benefits. You extract project risk. Then your project risk is clearly reduced to yourselves. Second, you could appreciate that unlike a situation where, take an example, if you have 100 as project cost plus VAT, it's make 120, 20% VAT. If you look at the lender perspective on the exposure, as a senior lender, the assets that you are using for securitization have the same value, whatever scenario. If you extract these guys, the same asset that you use as a collateral is against 100 instead of 120. Then again, benefit for you as a senior lender, the same security package become now only shared among senior lenders because you extracted part of the risk by transferring it directly to the state. If you don't do it, I would say bad luck, because you lost all the VAT receivables as a security, and you increase the total senior lending exposure to the very same security package that is getting diluted. Then lot of benefits. Second, the debt service reserve. Here, used to be an approach where this was funded with the 6 months first revenues from your plant, which is great, but the problem is that it's delaying your repayment as a senior lender because you have to fund first the fund, and then when it's funded, you start your repayment. But you remember, we have this unpredictability, we have this issue with revenues, then the earlier you could get repaid, the better it is. Then what do we do here? Usually, in a renewable energy project, we will try to get, and the sponsor will offer that to you, what we call the debt service reserve facility that sometimes are often unfunded, but with a sponsor guarantee. Again, you extract part of the cash somehow by transferring the risk to the sponsor. With the facility, you have to check, you could even ask for a bank guarantee if you want. But the benefit is, instead of increasing your financing cost because you had to finance indirectly, cash is fungible, then your debt service reserve account, you extract that amount of cash. Again, you lower your project cost, and you extract part of the risk to transfer it back to a third party. Again, I could call it blending, because I blended my financing by extracting 6 months of revenues out of my project. And these guys will become a partner. And if you find somebody able to provide you with a guarantee for that stuff, good for you. And then you have a new partner which, how to put it, find its place within your financing, but in a way which is very like, how to put it, virtual. Then it's a virtue instead of being a pain. And this is very much what we are trying to say.
I have a question about the DSR facility. Is there a difference between the DSR facility, DSRF, and DSR-LC, letter of credit?
No. This is, again, this is very much the same concept. Then it's a financial feature where you extract the risk, and you are comfortable with the way you could call the cash. The same.
So for me as a lender, both are the same?
Yeah. I mean, okay. It depends which type of, I would say, guarantee or feature you have. But yeah, this is the thing. And it's very common for renewable project. Yeah.
Hi, just a simple question. Who should find a junior lender? A developer or a senior lender? How does it work? Can we compare it with the syndicated loans or? No, it's different. You will see in presentation 4 that we will approach the structuring from the perspective of how you do it and what type of legal document you have to put in place. Anyhow, among lenders, you should be seeking what we will call an intercreditor agreement or kind of common terms agreement. Because you can't let any lender, junior, senior, whatever, go on its own. No way. Then, at the end of the day, yeah, might be your sponsor will say, you know, I have a friend of mine, I'm working with him, because they will always try that. With many projects, they are so good, they are so flexible, they are beautiful. Great. But at the end of the day, you will sign an agreement with them. Then you must be happy with them. And my advice is that I've never seen, let's say, a situation where if you don't know the lender, things go well.
because you will have to meet on a regular basis. You will have to agree on a financial model. You will have to agree on the term of the subordination. And if things go not that well, in particular, I guess you're all familiar with this business of event of default or potential event of default, you must agree among yourselves, do we declare a default or not? Then you may accept that they introduce you to a junior lender or whoever, but my advice will be you must be ultimately happy with them. And some of them are totally useless. No. It's you have to know them. Now, in terms of syndication, again, I'm the culture from like IFIs. Then we at DBRD were using the World Bank AB loan structure, and we'll speak about it later because not everybody could be a B lender. You have to qualify under certain conditions, and the big difference will be that if you syndicate a loan AB structure or even C, you have, but in an AB way. What is happening is that the IFI is somehow representing all the lenders, but the risk is transferred back to the B lenders, with one exception, which is that all the privilege and immunities that are granted to the A lender are automatically granted to B lenders. And I didn't want yesterday to spoil a Demba business, but an IFI has the same right as the one he's trying to get from MIGA in his fancy scheme that he wanted to sell yesterday. So in fact, they have an automatic right to get convertibility, an automatic right to get repatriation of funds, and if you are a B lender under an AB scheme, automatically you get the privilege from the IFI. Then this will be what makes a big difference. You could be a senior lender not eligible to a B loan, and then you are a bit more exposed. But we'll come to the structure later.
I was just wondering, in your experience, do you usually contract cash sweep mechanism in this real estate?
We will have that.
Yeah.
Then, in fact, in the cash waterfall, will come the question: how do we clean the balance sheet? Then we come with our sweep, and then we will have a cash sweep. You will see we have a little, should I call it a quiz or a game or whatever, later today. And you will see that in the model you will be using, the cash is building up. And then to an extent where you will think, look, I have to sweep that. I have to get somebody to use it, in particular in a context where too much cash in the company is never good, because you never know what will happen. Somebody may run away with it. And then somebody could get repaid and you lower the interest. But you're right, it's essential in our renewable project, because we have to sweep the cash. We can't leave it in the company. Then this will come, yeah. Now, equity. Equity from sponsors. On here, again, this is where blending is a bit of a pain. Oh, sorry.
Just a quick question on the DSRA and the DSRF. Because in the beginning you said, right, that the borrower can take out cash from the beginning. And this is something that we don't like as lenders.
Yeah.
So wouldn't it then be nice for the lender to install a DSRA such that they have to use that cash in the beginning to, let's say, fund that DSRA, even though we get repaid a little later, because if not, that cash is gone, right?
You're right.
Through the
You're
cash
right.
waterfall,
You're right.
all free cash flows,
You're right. But
they can assign to themselves.
No, you're right. But in terms of equity, on remuneration of equity, we will use two principles. Equity first in terms of investment, and no dividend payment before you are, as a lender, getting your first repayment. No way. Then that situation whereby a sponsor will start extracting value at the time the lender are still at risk can't happen. Normally, you should have legally structure your deal in such a way that there is no way the equity holders could get $1 out of the project before you as a lender. Now, what will happen, and when do we inject money into the debt service reserve account? We will do it before we start our repayment. At least 6 months or a year, but 6 months is a usual norm. Then, if we think at the cash flow or the way the cash is injected in the company, we have, at the time of construction, equity first, then disbursement of the loan. You complete your project, you fund your DS debt service reserve account, or you arrange the facility with a letter of credit or whatever equivalent. Then you enter repayment, and then you could consider dividend. That sequence. And it could only be that one. But sponsor will try the other way. Sponsor will try to put equity later. They will try, and we will see that, to convert whatever investments they made into non-cash equity. Then we will see that risk, and they will try to extract cash very early. I will give you example after that slide, but it's very common what they try to do. Then, first, the risk we have in our renewable project is that sponsor equity, how to put it, number of sponsors would try to convert their earlier investment into equity. They will say, look, you know what, I got huge development cost. Okay, how much? And then the amount will be, woo, absolutely, I mean, like huge. And then sometimes you have an invoice where, for example, they got a permit for the land. Okay, why not? It's a contribution. Sometimes they call it internal development cost. Whoops, that one is I mean, it's really something that will create you a problem if you start remunerating a cost which isn't even proven at the interest or at the return on equity rate, which is not acceptable. Very often then you will see that they inflate fees, in-kind contribution on whatever cost they had. Second, the rule, and you have to really make sure that they come first before you consider any kind of loan. Otherwise, they are not exposed to the project. Then comes the question of blending with grant. And here, I guess you all heard about EU coming with equity, and then there is this constant thing, you know, there isn't enough equity or capital to support renewable project, and then you have a smart civil servant from Brussels who never finance a single project that come with a facility because they don't care about the money. It's all monies, and then they will say that they boost renewable energy by providing grants to anyone at any cost. Our problems is, as a financer, is that these guys are killing our business because in a context where you have so little equity already in, sorry to say, you have to get a minimum to get a sponsor exposed. Yeah, I appreciate that if you help a sponsor by providing half of the equity in grant, he will just be happy and he will tell you, oh yeah, you know what, I will do more project. Fair enough. But if you have so little exposure to a project, I mean, you don't care. And this is where, by trying to be nice, they kill the thing. And second, the amount of equity is in essence so low already now in our business that this is not the place where you should provide your support. And we will see that junior facility on first loss are much better than whatever equity on grant. Then this is our thing. Might be an exception, could be if you want to put seed money to help, for example, licensing or to facilitate or to increase or enhance the regulation, welcome. But nothing like grant to support equity investment into a project, because then you are killing the business ultimately. Then here you have really to make sure that the return on equity is consistent with the market. Why is that? Because if you are clearly way out, too low or too high, you will be in trouble. In particular, in developing countries, returns when they are too high exacerbate political tension, and they are the best recipe to create trouble and then to have everything being somehow reconsidered by the next government. Then you are even putting yourself as a lender at risk, which is not good. If it's too low, then the big question will be, why are they investing? Okay, people like green, but why is that? Then you have to check what is the return on the profile, meaning the way the cash is extracted must be consistent with your exposure, so that when you feel still exposed, could it be in money term or in reputation term, these guys should still be incentivized to perform. Otherwise, they won't care. What we want here to demonstrate is that then blending is a natural attribute of renewable project. And I think this was very much what you wanted to discuss during this seminar, but complementing presentation you will hear tomorrow, where Convergence will show you blending from the top. OECD did the same. Now we will take a different perspective where blending is good for us. Then you are not any longer forced to please your boss. No, you need it. We have our overall project cost, and normally you will have equity on senior debt, and you will do your project. You will be happy with that. Nothing to worry about. But in our case, we will try to use a slice of junior debt, and we'll see what type of subordination we could be considering. We could have grant, always welcome, but you notice that I didn't put that against equity. I put it against debt. And then finally, you could have your VAT facility. And then we'll see in the next slide the benefit of each of them. Sorry, letter of credit for the DSCR. Then each of them is coming with its own feature. Then we have the senior debt. Then what does it offer us? First, you will be seeking a long-term institutional lender that will provide you with all the knowledge, institutional thing in relation to regulation, on other exposure to similar project. What you will be getting is what we call an implicit political risk coverage. But there is only a single government, or there is a only one? Okay. Then doesn't make you then a fully fledged multilateral or IFI, because what is a unique feature of an IFI is that the government or the state in which you invest is a shareholder. And it changes everything, because legally speaking, as a consequence, where you invest under the treaties that establish the institution, and not only the local law. Because the state that enter into the agreement with that entity confirm certain obligations it has vis-à-vis you. De facto, if you have an IFI, you will get this implicit risk coverage on the political side. This could be of your interest to complement your action. And then, this is what you were talking about. It will come with privilege and immunities in case of an IFI with AB loan structure that automatically will be granted to you in case of a memorandum or whatever. Then you are extracted from all this huge financial restructurization. Then if I take, I guess some of you are familiar with Zambia. Zambia was under a memoranda, was it 2 years ago or 3 years ago, because they defaulted on their senior debt. All the IFIs were immune. And you remember Demba spoke yesterday about access to dollar. There was no dollar available in Zambia during 4 years. Nothing. Not a dollar will go out except IFIs. Then if you are here, you are safe. Then we continue with our slice of funding, junior debt. Now we address few things. First, you remember that business of gross profit. Then we have excess cash available. How do we manage it, and what do we do with it? Then, then we will try to use this gross profit to repay our loan. We will try to avoid excessive equity return. Then some clever sponsor that knows what you want will also offer you to be part of a junior debt. Then if they manage to do it, then they know a local bank. Then the bank will do, or local bank or international bank, but they will do the funding on the bank side, but the risk will be on the sponsor. Then they will in fact say, look, I am taking equity, but I will take junior debt. Suez was always very good at doing that, and they will arrange a junior facility backed by Suez, and they will only have BNP Paribas doing the funding. But fine with you. I mean, it's not your business, as long as it's agreed and it's transparent. But you have this situation where you will also try to get this junior debt out of the security package so that it increases the relative value of the security package for you as a senior lender. So this is a clever way of boosting somehow your position. Now, we have this VAT facility. As we said, we extract some cash or some project cost, from the project risk by saying 20% is out, then it's good. It reduces the pure and project financing exposure. You might get a local bank partner so that you could get local influence on what is happening, and this will be local currency, because there is no point financing in dollar, VAT expense in local currency. I mean, there is a loss for everybody here. And then the debt service reserve facility, again, you extract it from the project risk, and you might reduce your financing cost. Mustafa, sorry. Microphone.
What is the difference of the costs between different instruments, and particularly for renewable energy? There is a difference between a normal project, because we find the same in any infrastructure project, but any specificity about the costs of the senior compared to the junior debts, and from, of course, grant is free, and the cost of VAT facility is something that we can find also, but there is any difference compared with a normal infrastructure and
that's a good fair point. I should
maybe
go
it's
back
for
to
later, because I used to spoil
right,
all
Mustafa.
of the time.
No, you're right. You're right. I should also be presenting that. Is common to any infrastructure project, and in any infrastructure project you will have VAT paid, and you could organize the VAT facility in a way which is similar to renewable energy project. This one, personally, I've seen that clearly much more used in renewable energy than in other projects. And again, goes back to this business of trying to reduce your project cost, because otherwise the debt service reserve account, then the one you fund, will come against your project cost. Then you will have to put in front of the project cost some funding, and then de facto you will increase the amount of funding required by an equivalent, let's say, of 6 months debt service. By having a facility, there is no cash. Then you reduce your project cost. And when you introduce that, you might, and this is a clever way, increase the sponsor exposure by asking the same sponsor, the famous ones that want to put very little equity, to just be a bit more exposed. Then there is a trick here, a benefit for you, because de facto you get back your sponsor into the project, but second, you reduce your project cost. Then that one, I would say, is very much renewable energy. After, you could use everywhere else, but in all kind of project, it's very much the case. Junior debt. Junior debt, my impression is that because of the two features I described, is that we generate always excess cash in renewable energy, unlike the others, and we have the second effect that our OPEX are nil, which is not usual. If I compare with a conventional power plant, if I have excess revenues, I have excess cost, then I have to pay for the gas, I have to pay for higher usage of my CCGT. Then in fact, I won't have a direct conversion between additional revenues and additional gross profit. In renewable energy, we have this direct equivalence. Then as you could imagine, you have junior lenders very, very interested to get that cash. Second, what a junior lender could do in renewable energy that he can't do in any other project, he could make up for himself the difference between an average production and a P90. I mean, you don't need a PhD in whatever financing to do it. And then you could figure out how much cash in average will be generated by that business. Then we call it junior because, yes, you run the risk of maybe a dry year or a year where the cash is not here, and then you postpone to the year after. But it could also be a situation where you have very cautious senior lenders, did use P90, and you structure your junior debt on P75. I mean, it's not a huge risk that you are taking here. Then to answer Mustafa's question, it's an ideal situation where you could structure facility which are clearly junior to the senior, in a sense that you postpone or you run the risk of being slightly delayed in terms of repayment without getting into uncharted territories where it's more like getting to the casino in case of something not running well. And as a consequence, the junior lender, and this is where blending could start here, if clearly are putting themselves not at P75 but at average, support from EU will be welcome. Therefore, they call it first loss, and the first loss will come at a rate that could even be somehow enhanced through a kind of support to the interest rate. And final maybe answer to Mustafa's question, in renewable energy, you will find very appealing junior debt facility, not as much as senior debt because they are fully secured or whatever, but still in a reasonable range in terms of interest, unlike other projects, because in other projects, there isn't much room. It's like saying, look, I run the risk of never being paid at all. Not in our case, not at all, yeah.
Thank you, Laurent. Just another question about the fact that the risk is very high for renewable energy before the start of the project.
Yeah.
And once the project is started, the risk is reduced.
Yeah.
As soon as you provide, you can prove that the production is there.
Exactly.
So there are many cases where the senior debt is repaid fully by, and there is no need anymore of senior debt because the project is running well. So the lender can take the money back and use it for another project and make it available for commercial banks to come. There are also cases
very
like
true.
that.
Very true. Or you structure a bond. But then this is where AFD or EBRD and the others will be in between two positions, because they like also nice assets on the balance sheet. Then repayment when you have taken all the risk is great, but thank you. Then at EBRD, again, you do whatever you want. Prepayment fees were going down because we're not that stupid. Then year one, 4% minimum. And it wasn't before year 5 that we were going at 1. And I could tell you 4%. Exactly. But still, but keeping in view that prepayment fees or whatever fee goes with a decision from the sponsor to refinance, should, you're right, allow the IFI to remobilize the fund, but also still create an asset class for you where you keep good companies in your books for long enough. So that's why, and you will see all the sponsors renegotiating the prepayment fees. But we are going very high in the first years. Otherwise, you don't make your money, because at the end, you still want to make money, and that's why. But on many sponsors will try to sell off their assets or to raise a bond. Because as you could imagine, this type of asset class qualifies for all green bonds. And this is very appealing because you merge it together, you end up with a big amount, and then poof, you go to the market, you structure a bond, in particular because you could have long maturity and people will die for getting into it. Okay, and then now the table, but we make it a little bit more fancy. Then you remember yesterday? It reduces your project cost and increases competitiveness, obviously, because you don't get them repaid. But the trick is that don't use it against that, but clearly only for pre-feasibility studies, permitting, licensing, some things that contribute to the project, but doesn't reduce the sponsor exposure. Otherwise, it's not helping. And this is the irony. Yeah.
No, I think just on your this slide here on the senior debt perspective, I think from an Africa perspective, also Africa, we've seen institutional investors, your pension funds, don't want construction risk, and normally the DFIs have to fill that in. So normally through a construction facility or something. So I think it's something that we have to really also think about because the construction risk is something that they really
No,
Dude.
they're not used to it. Yeah, yeah.
Yeah.
On they don't have the expertise. Hence, the benefit of coming on. Again, I don't want to promote a single institution, but the reason why EBRD wanted to go to Africa was to team up somehow with IFC or complement IFC and bring that expertise. Because, funny enough, African Development Bank is like a librarian that doesn't want books to get out of the library, you see. So they are very happy sitting on the pot of money. And as soon as they see a project, they shy away. Oh, you want me to invest? No, please. No. Then that's why you need to get senior lender able to take that risk. Otherwise, yes, they are not present enough. Surely, yeah. Which is a pity. Yeah.
So on the grant, I've seen projects where the grant, we can put a mechanism that can cap the return of the sponsor. Where basically the grant says if the project achieves a certain level of IRR, beyond that IRR, the sponsor has to repay the grant. And it's a way also to put in place a grant in projects where we have the risk that the sponsor achieves a higher IRR than what they're supposed to. And the question I have is regarding the junior debt. I've seen in many projects where when we size the debt, the senior debt, where the constraint is not the DSCR but the leverage, the gearing, which means that if we're limited by the gearing, I don't see how we can have a space for junior debt, because basically if we put in place, because basically we can cover all the debt with senior debt. Because it achieves the DSCR, right?
Sure.
So I don't see the incentive for the sponsor to accept a junior debt tranche that is more expensive than the senior debt, where the project can
you're right.
Yeah.
They will say no, except that you will say, look, with my senior debt being structured at P90, I generate cash. What do you do with the cash? Then either you, as a senior lender, have a prepayment mechanism. You extract the money and you prepay you, but ultimately were you really senior, or were you not admitting that you put half of your debt in a junior position? Because de facto this is what you're saying. Then by saying upfront, look, you have to remunerate somebody that take certain risk, which can't go to the sponsor, is possibly more transparent. But they won't like it, huh? They won't like it, surely.
So in that case, if we add the junior debt, whereas in a project where the debt sizing already achieves the DSCR, it means that the senior debt tranche will have a higher DSCR than the guideline.
Exactly, yeah.
Okay.
Because otherwise you can't get paid. And then to make it fancy, we call it first loss. Not junior debt, it's more, Okay. But you're right, sponsor won't like it because they prefer a single lender, cheaper, seniors and normally lower interest rate with a prepayment mechanism, easy life. To go back, to the table we saw yesterday. You remember the table yesterday was about sizing our senior debt using various mechanisms. In particular, we were having contract type of take you've got. Category A will be ours normally with a single buyer model. And then for each technology, we have a more prudent approach where we have a P scenario and a DSCR being used to structure. But you could go one step further now that we learn about who is doing what. And then you could say, look, depending on the type of contract, I will also impose a minimum equity level. And then possibly I will be willing to accept a 15% equity contribution for easy peasy project solar category A, but I will be much, much more demanding in category E. And it goes down to this business of having project being identified, your risk profile being then defined, and then you go ahead by having a kind of, I would say, a consistent approach to financing. One thing which will be very important, because the more you stretch a bit your projects, the more you are at risk of maybe running short of cash. The key will be the tail. Then you remember it's what we discussed yesterday. It's a difference between the term of your PPA and the tenor of your loan. Whatever is left is called the tail. And the tail will be very useful because it's potentially an amount of revenues or cash that you could use in case of something happening like unforeseen, like tariff being renegotiated. You didn't anticipate it, but you could then reschedule your loan, and you know that there is a bit of room for maneuvering. The big problem is that in a market there is no tail, in a sense. Then that trick won't work. Hence the fact that you will be very, very adverse to that type of risk. The same goes with the tenor. The tenor and your ability to forecast the risk will clearly vary depending on the category of project. Category A, it's a single buyer with a creditworthy counterpart. You could take 20 years because maybe potentially it's a government which is backing, or state which is backing the PPAs, and there is no risk. Category C or D, I don't know if you remember, this is a case where you sell to a corporate, whoever needs electricity, and between C and D, it's either you got a way out if this corporate is broken down or doesn't perform, or not. Then C, you have a way out, D, you don't have a way out. And again, this duration will reflect your ability to foresee how your counterpart will be performing. To remember cases that I've seen, I remember when I was in the old good time of Alstom, when they were still having a power activities and they were doing IPP, we will have sold energy to ArcelorMittal. 15 years will have been more than enough, because now today they close down everything. I mean, nobody could imagine that in 2000. Therefore, it shows that when you have big energy consumer, it's really something that you should forecast. I mean, same with aluminium smelters, which use huge amount of energy. Again, what is the aluminium market? Oops. Maybe in 5 years' time, no one knows. We will possibly not have any longer facilities in a country or the other. So just to say that you will adapt your tenor to this risk profile.